The five-step model for revenue recognition that you will explore this week was effective for public companies with reporting periods beginning after December 15, 2017, and non-public entities reporting under U.S. GAAP were required to apply the revenue standard for all annual periods beginning December 15, 2018. In Week 4, you learned about revenue as part of the income statement and comprehensive income review. Now you will closely examine revenue for a company and determine the timing of revenue recognition and record revenue based on the new revenue recognition principles. U.S. GAAP defines revenue as inflows or other enhancements of assets of an entity or settlement of liabilities, or perhaps a combination of both from a firm delivering or producing goods, rendering services, or other activities that constitute the entity's ongoing major or central operations. In translation, revenue is the inflow of cash or accounts receivable that a business receives when it produces goods or services that it delivers to its customers in the ordinary course of business. There are two central questions we explore when it comes to revenue recognition. First, how much revenue can we recognize or record, and when can we recognize or record it? And we turn to these with the revenue recognition principle. Prior to the recent accounting standards update, the existing revenue recognition principle was as follows. Revenue should be recognized and recorded when it is realized or realizable or when it is earned. The new guidance establishes the following core principle. Companies recognize revenue when promised goods or services are transferred to customers for amounts the company expects to be entitled to receive in exchange for those goods or services. The problem with applying the realization principle was that revenue recognition was poorly tied to FASB's conceptual framework as reviewed in earlier chapters. The focus on the earnings process led to similar transactions being treated differently within different industries, and it was difficult to apply under complex arrangements that involve multiple goods or services. The new revenue recognition standard by FASB provides a unified approach that it replaces more than 200 different pieces of specialized guidance that had developed over time under U.S. GAAP for revenue recognition for various industries and circumstances. This core principle allows companies to recognize revenue when goods or services are transferred to customers for the amount the company expects to be entitled to receive in exchange for goods and services upon transfer to the customer and in the amount the seller is entitled to receive. The five-step revenue recognition model under Accounting Standards Update 2014-9 is as follows. Step 1. Identify the contract. Step 2. Identify the performance obligation or obligations. Step 3. Determine the transaction price. Step 4. If applicable, allocate the transaction price to the performance obligations in the instance when there's more than one. And finally, Step 5. Recognize revenue as a performance obligation is satisfied. We will explore the five-step process of revenue recognition through the case of the Bean Coffee Shop. Taylor orders a large cup of black coffee, costing $3 from the coffee shop. Taylor pays $3 to the barista, who then pours the coffee into a large cup and hands it to Taylor. First, we explore Step 1 in more detail before applying it in context to the Bean Coffee Shop transaction. Step 1. Identify the contract with the customer. A contract is an agreement between two or more parties that create enforceable rights and obligations. Step 1 is met for utilizing the following criteria. First, there is approval and commitment of all involved parties. Second, the rights of all parties have been identified. 3. The payment terms have been identified. 4. The contract has commercial substance. Commercial substance means that the expected future cash flows will change because of the transaction. And 5. It is probable that the reporting organization will collect the consideration to which it is entitled in exchange for the goods or services that will be transferred to the customer. So now let's explore the transaction between Bean and Taylor. Both parties have approved and committed, in that Bean has offered up the coffee available for sale and Taylor has willingly agreed to pay $3. The rights of the parties have been identified in that Bean is eligible to be paid the $3 for the cup of coffee and Taylor is entitled to that black cup of coffee. Payment terms have been identified. $3 on the spot before delivery has occurred. The contract has commercial substance in that Bean is $3 richer and Taylor is $3 poorer, but yet has the caffeine that will fuel her system for the remainder of the day. And 5, it is probable that the payment will be collected again because that payment is due upon demand before the transaction and delivery take place. Next, let's take a look at Step 2. Identify the separate performance obligations in the contract. The idea is to separate the contract into parts that can be viewed on a standalone basis. A performance obligation includes promises to transfer goods or services to a customer. If those goods or services are distinct, the promises are performance obligations and therefore accounted for separately. A good or service is distinct if it can meet both criteria. First, it is capable of being distinct if the customer can use the good or service on its own or together with goods or services that can be attained elsewhere. And second, it is separately identifiable. The seller is promising to provide goods or services individually as opposed to promising to provide a combined good or service for which the individual goods and services are inputs. In the case of Bean Coffee Shop, in Scenario 1, the black cup of coffee is a single performance obligation. It is both capable of being distinct as it is offered on its own, and it is separately identifiable in that it is the only deliverable embedded within this transactional relationship. In the prior slide, we saw that promises to provide goods or services are treated as performance obligations when the goods or services are distinct. Now let's consider several aspects of contracts we can encounter to explore their existence as a performance obligation. The first is a prepayment. We don't consider such prepayments to be performance obligations because they aren't a promise to transfer a product or service to a customer. Instead, they are an upfront fee, which is an advance payment by the customer for future products or services and should be included in the transaction price allocated to the various performance obligations in the contract and initially recorded as unearned or deferred revenue and recognized revenue when or as each performance obligation is satisfied. The second is a quality assurance warranty. A quality assurance warranty, sometimes called an assurance-type warranty, is not a performance obligation. Rather, it is a cost of satisfying performance obligation to deliver products or services of acceptable quality. And the third is a right of return. These are part of the performance obligation to deliver goods or services that a customer wants to keep. They are viewed as a variable type of consideration, and the transaction price is adjusted to account for that. The following are viewed as separate performance obligations. The first is an extended warranty. An extended warranty, sometimes referred to as a service-type warranty, provides protection beyond the manufacturer's quality assurance warranty. Because an extended warranty is usually priced and sold separately from the product, it constitutes a performance obligation and can be viewed as a separate sales transaction. The price is recorded as deferred or unearned revenue and then recognizes revenue over the extended warranty period. Second is an option. An option granted to the customer to receive additional goods or services at no cost or at a discount also qualifies as a performance obligation. These can include software upgrades, customer loyalty programs, discounts on future goods or services, or contract renewal options. Options for additional goods or services are performance obligations if they provide a material right to the customer that the customer would not otherwise receive. When a contract includes an option that provides a material right, the seller must allocate part of the contract transaction price to that option. Just like other performance obligations, the allocation process requires that the seller estimate the standalone selling price of the option, considering the likelihood that the customer will actually exercise the option. The seller recognizes revenue associated with the option when the option is exercised or it expires. The allocation process will be discussed later in the chapter. On occasion, more than one company is involved in providing goods or services to an end customer. In those situations, we need to determine whether a company is acting as a principal and providing the good or service to the customer, or an agent and only arranging for another company to provide the good or service. We view the seller as the principal if it obtains control of the goods or services before they are transferred to the end customer. There are various indicators that help determine whether a seller has obtained control. Control is indicated if the seller has the primary responsibility for providing a product or service that the customer finds acceptable, if the seller has discretion in setting prices, and/or if the seller is vulnerable to the risks associated with holding the inventory or having the inventory returned to the seller. A principal's performance obligation is to provide a good or service. In contrast, an agent doesn't primarily provide the good or service, but instead acts as a facilitator that receives a commission for helping the seller provide goods or services to the end buyer. An agent's performance obligation is to facilitate a transaction between a principal and a customer. The distinction between a principal and an agent is important because it impacts the amount of money that a company can record. If the company is the principal, it records revenue equal to the total sales price paid by the customer, as well as the cost of goods sold equal to the cost of the item. On the other hand, If the company is an agent, it records revenue only as the commission it receives on the individual transaction. Step 3. Determine the transaction price. The transaction price is the amount the seller expects to be entitled to receive from the customer in exchange for providing goods or services. In most cases, the transaction price will be a fixed amount, but it can sometimes include variable consideration or consideration in a form other than cash. The transaction price can be adjusted for the effects of the time value of money if the contract includes a significant financing component. If this is the case, the seller should view the transaction price as consisting of two separate components: a delivery component equal to the cash price of a good or service, and a financing component, which is the interest paid to the seller. So the real question is, when is a financing component considered significant? This is a matter of professional judgment, but there are indicators we look to suggest significance. If the customer would pay a substantially different amount if it is paid in cash at the time of delivery, the financing component is likely significant. In addition, the financing component is more likely to increase in significance as the time between delivery and payment increases, or if the interest rate implicit in the contract is large. As a practical matter, sellers can typically assume that a financing component is not significant if the period between delivery and payment is less than 1 year. In addition, the transaction price can be variable, in which a portion of the transaction price depends on the outcome of a future event. Contracts that include this variable consideration are commonplace in many industries, including construction, perhaps incentive payments for early completion, entertainment and media in the example of royalties, healthcare in the example of reimbursements, manufacturing in the example of volume discounts or product returns, and other rebates. A seller estimates a variable consideration either at the expected value, calculated as the sum of each possible amount multiplied by its probability, or the most likely amount, depending on which estimation approach better predicts the amount that the seller will in fact receive. As we look at the coffee shop example, the transaction price is in fact fixed in this example at $3. Step 4. Allocate the transaction price to the separate performance obligation. This step is only in existence in a contract where more than one performance obligation exists. In this instance, the seller allocates a transaction price to each obligation in proportion to the standalone selling prices of the goods or services underlying all performance obligations in the contract. This will be like the treatment for a basket purchase allocation that we'll discuss in the fixed asset chapter. The standalone selling price is the amount in which the good or service is sold separately under similar circumstances. Let us keep in mind that in the coffee shop scenario 1, this step 4 is not applicable as there was only one performance obligation. As discussed earlier, we know that the seller must allocate the transaction price to each performance obligation in the contract in proportion to the standalone selling prices of the goods or services embedded within the contract. When goods or services are not normally sold separately, a seller must then estimate those standalone selling prices. There are various approaches available for estimation. Examples we will highlight include the following. First is the adjusted market approach, where the seller considers what it could sell the product or service in the market for which it normally conducts business. Perhaps we reflect on the prices charged by competitors. The second is the expected cost plus margin approach. Here, sellers estimate their cost for satisfying the performance obligation and then add an appropriate profit margin. And third is a residual approach, where the seller estimates an unknown or highly uncertain standalone selling price by subtracting the sum of the known or estimated selling prices of other goods or services embedded within the total transaction price of the contract. The residual approach is allowed only if the standalone selling price is highly uncertain, either because the seller hasn't previously sold a product and hasn't yet determined the price for it, or because the seller provides the same good or service to different customers at substantially different rates. The final step, Step 5, recognize revenue when or as the entity satisfies the performance obligation. A seller recognizes revenue when or as it satisfies a performance obligation by transferring a promised good or service to a customer, for which then the customer obtains control of that set good or service. Control means that the customer has direct influence over the use of a good or service and obtains its benefits. The seller recognizes revenue at a single point in time when control passes to the customer, which is more likely to have occurred if the customer had the obligation to pay the seller legal title to the asset, physical possession of the asset, the assumed risk and rewards of ownership, and accepted the asset. The seller recognizes revenue as or over time if the customer consumes the benefit as the work is performed, The customer controls the asset as it is created, and ultimately, the seller is creating an asset that has no alternative use to the seller, and the seller has the right to receive payment for the work completed. For the following transaction types, including licenses, franchises, bill and hold arrangements, consignment arrangements, and gift cards, all create some complexities in determining the timing for revenue recognition, and these are highlighted here. As we close out Step 5, in Scenario 1 for a coffee shop, we seek to understand the following elements of control embedded within. First, the obligation to pay the seller. Taylor is obligated to pay $3 before control is transferred and physical possession occurs for the coffee to be transferred to Taylor. Legal title to the asset happens at the time of delivery. We assume risks and rewards of ownership are accepted. So, Taylor has the right and the honor to enjoy that caffeinated morning. And finally, the acceptance of the asset occurs upon delivery. Therefore, it is in Step 5 that we would record the journal entry. A debit to cash for $3 to increase that asset account, and a credit to revenue, ultimately increasing the revenue increase retained earnings, which ultimately increases stockholders' equity for $3. Next, we move on to a second scenario for the Bean Coffee Shop. The following day, Taylor orders another large cup of coffee for $3 and also purchases 2 bagels at a price of $5. The barista provides these items and Taylor pays the $8. Here, we will highlight the appropriate steps that are most applicable in Scenario 2. Let us fast forward to Step 2. Identify the separate performance obligations in the contract. Here, Bean must determine whether the sale of coffee and the sale of 2 bagels involve 1 or 2 performance obligations. In the previous transaction between Bean and Taylor, this was determined as straightforward because Bean provided a single distinct product, a large black cup of coffee, and therefore only 1 performance obligation existed. However, an arrangement to purchase a coffee and 2 bagels may have more than 1 performance obligation. Multiple performance obligations exist when the following 2 conditions are satisfied. Bean must provide a distinct product or service. In other words, Bean must be able to sell the coffee and bagels separately from one another, and Bean's products are distinct within the contract. In other words, if the performance obligation is not highly dependent on or interrelated with other performances in the contract, then each performance obligation should be accounted for separately. Conversely, if each of these products was interdependent and interrelated, these products would therefore be combined and reported as 1 performance obligation. The large cup of coffee and the 2 bagels appear to be distinct from one another and not highly dependent or interrelated. That is that Bean could sell the coffee and the bagels separately. And in fact, we saw Taylor do this just the previous day. Bean should therefore record 2 performance obligations, 1 for the sale of the coffee and 1 for the sale of the bagels. Conversely, assume that Bean sold a large lot comprised of coffee and milk to Taylor. In this case, Bean sold 2 distinct products, milk and coffee. But the 2 are not distinct within the contract. That is, the coffee and milk are in the latte and highly interdependent and interrelated. As a result, these products in this example would be combined and reported as 1 performance obligation. Next, we look to Step 3. Determine the transaction price. The total transaction price is $8. Next, we look to Step 4. Allocate the transaction price to the separate performance obligations. Bean has 2 performance obligations, 1 to provide the large cup of coffee and 2 to provide the 2 bagels. Each of these obligations is distinct and not interrelated and priced separately. Therefore, no allocation of the transaction price is necessary. That is, the coffee sale is recorded at $3 and the sale of the bagels is recorded at $5. Finally, we move to Step 5. Based on having met the same criteria for transfer of control, we would record the journal entry as a debit to cash for $8 and a credit to revenue for $8. This transaction could be accounted for separately if delivery occurred at separate times, where we credit revenue for $3 for the coffee and $5 for the bagels. Now we move on to Scenario 3. Bean decides to provide an additional incentive to its customers to shop at its store. Bean is interested in stimulating sales of its in-house roasted coffee beans on Tuesday, which is a slow business day for the store. Normally, these beans sell for $10 for a 12-ounce bag, but Bean decides to cut the price by $1 when a customer buys them on Tuesday. Taylor has come into the store on such a Tuesday and decides to purchase a bag of coffee beans and pays $9. For Scenario 3, we fast forward to Step 3, having met Steps 1 and 2 in a straightforward manner. Step 2 is straightforward in terms of performance obligation, as there is only one performance obligation to transfer a bag of coffee beans to Taylor at the end of the contract. In Step 3, the transaction price for the bag of coffee beans sold to Taylor is $9, not $10. The transaction price is the amount that a company expects to be entitled to in exchange for transferring goods or services to a customer. The transaction price in a contract is often easily determined because the customer agrees to pay a fixed amount to the customer over a short period of time. In other words, in contracts, companies must consider adjustments they make, such as payments to provide some other consideration to a customer. In this example, a coupon is part of that revenue arrangement. Given there was only one performance obligation, we fast forward to Step 5, where we record revenue similar to our prior scenarios: a debit to cash for $9 and a credit to revenue for $9. Next, we move on to our final scenario, Scenario 4. Bean wants to provide even more incentives for customers to buy its coffee beans, as well as purchase a cup of coffee. Bean offers customers a $2 discount on the purchase of a large cup of coffee when they buy a bag of its premium coffee beans, which normally sell for $12 at the same time. Taylor decides this offer is too great to pass up and buys a bag of premium coffee beans for $12 and a large cup of coffee for $1. Keep in mind that a large cup of coffee normally retails for $3 at Bean Coffee Shop. Here, we fast forward to Step 2. The bag of premium beans and the large cup of coffee are both distinct from one another and not highly dependent or interrelated. Bean can sell the bag of premium beans and the large cup of coffee separately. Furthermore, Taylor benefits separately from both a large cup of coffee and a bag of premium beans. In Step 3, the transaction price for Scenario 4 is $13. In Step 4, Bean allocates a transaction price to two separate performance obligations based on the relative standalone selling prices. The standalone selling price of a bag of premium beans is $12 and a large cup of coffee is $3. As indicated, the total transaction price of $13 is allocated at $10.40 to the bag of premium beans and $2.60 to the large cup of coffee. Next, we transition to revenue recognition over time, keeping in mind that a seller recognizes revenue over time if the customer consumes the benefit as the work is performed. The customer controls the asset as it is created, and the seller is creating an asset that has no alternative use to the seller, and the seller has a right to receive payment for the work completed. While the accounting standard update for the revenue recognition guidance removes the term percentage of completion method, both the process and the journal entries to account are the same under the cost of cost basis. The percentage of completion is determined by comparing the total cost incurred to date to the most recent estimate of the total cost. This percentage of percent completion is then multiplied by the estimated total revenue to get revenue to be recognized to date. This revenue recognized to date is subtracted from any revenue recognized in prior periods to determine our current period revenue recognition. First, we'll introduce two new balance sheet accounts utilizing revenue recognition over time. The first is construction in progress. This is an inventory account or a work in progress, or WIP account used to accumulate all construction costs incurred each period on the long-term contract, as well as the gross profit recognized in each period. Progress billings on construction in progress is a contra-inventory account that is used to accumulate all progress billings each period on the long-term contract. When CIP is greater than billings, this is viewed as a contract asset and labeled as construction in progress in excess of billings. Conversely, when progress billings is greater than construction in progress, this is used as a contract liability and labeled as billings in excess of construction in progress. Unfortunately, losses sometimes occur on long-term contracts. As facts change, sellers must update their estimates and recognize losses, if necessary, to properly account for the total amount of revenue that should be recognized to date. How we treat losses in any one period depends on whether the contract is overall profitable. A loss could be either a periodic loss that occurs on an overall profitable contract or projected on the entire project. We have to consider periodic losses only if revenue is recognized over time, but we have to consider overall losses regardless of the timing of revenue recognition. I recognize that this has been a long presentation, but keep in mind that revenue recognition is one of the most important and complex topics that a company reports in its financial statements. Apart from presenting both the accounts and balances on the financial statements, there are several other important aspects of revenue recognition that must be disclosed in the footnotes. On the income statement, of course, the company reports revenue in its income statement. In addition, the seller is required to include in its income statement or disclosure notes any bad debt expense and any interest revenue or interest expense associated with any significant financing components of long-term contracts. On the balance sheet, a seller reports accounts receivable, contract liabilities, and contract assets on separate lines in its balance sheet. There are several important aspects of revenue recognition that must be disclosed in the notes in the financial statements. For example, sellers must separate their revenue into categories that help investors understand the nature, amount, timing, and uncertainty of revenue and cash flows. Categories might include product lines, geographic regions, customer types, or types of contracts. Sellers must also disclose the amount included in revenue that was previously recognized as deferred revenue and or that resulted in changes from transaction prices. Sellers must also describe their outstanding performance obligations, discuss how performance obligations typically are satisfied, and describe important contractual provisions like payment terms, policies for refunds, warranties, etc. They must also disclose any significant judgments used to estimate transaction prices, allocate transaction prices to performance obligations, and determine when performance obligations have been satisfied. Sellers must also explain significant changes in contract assets and liabilities that occurred during the period, with the overall objective of these disclosures to help users of financial statements understand the revenue and cash flows arriving from contracts with customers.